Welcome to my channel. I'm Dr. Romano. This video concerns the SPX and the stock market. It is now May 20th of 2022. And as you've noticed, the SPX has been going down since I've predicted it's going down. If you watch my previous video, you'll notice that I made some predictions about the SPX. And I gave you a tip on when to enter and when to exit. Well, it seems like the SPX is still going down. However, it will start to trade sideways and it will pretty much be at its lowest in July, mid-July, mid-August. So it's going to continue going down, of course, but it's going to trade sideways and then go down a little bit and trade sideways, etc. Because it has reached a critical point. It's pretty much its lowest for 12 months. But when it stays that low, it doesn't just, turn around and go back up again. There's a number of issues that are coming about in a number of companies that these companies have to, one, deal with not having products that they can't sell because it's not being made fast enough, because there's supply issues. And then, of course, it's going to take some time for those companies to actually bring the products here to be made. And so this time period is a real transition, and it's beautiful that these time periods come about. And of course, you have higher interest rates, and it's going to continue to go up for at least 7 years, at least, because the government needs us to save money. And so the reason why interest rates go up is so that people put their money in savings accounts and earn interest as a way to get them to save money. So if you could earn 7% interest in a savings account, would you do it? I certainly would. Because when you buy real estate and you rent it out, you're not going to make no 7%. And in the stock market, if you're not savvy, you're not a doctor of trading or whatever it is, trying for you to actually make a stock portfolio and make money and make more than 7% a year, it's pretty tough. So please remember that if you do like my videos, to subscribe to my channel, because I always put out future videos about a particular topic. And also remember that it really would help me out if you do thumbs up. That tells me that you liked my video, of course, because I'm providing this information for free. So to thank me, please remember to do thumbs up. That's the direction, as I mentioned, and that's the reason why it's happening. Secondly, there's a lot of traders right now that are having to reposition their portfolios, including portfolio managers. Everything has to be re-looked at, and I know this to be a fact because I used to work for the investment bank, and my particular job at that time was to review the trading books on a global basis every morning before the chief financial officer looked out at those books. So basically, when he looked at them, all the areas had to be reported that were in red. There had to be precise notes. Any areas that weren't submitted, I had to get them to submit their data. And any areas that didn't submit their data, I had to explain why. And so it was a very important job. I was very lucky, and I was a very lucky kid. Of course, it doesn't, your whole life is not going to be lucky. But I learned something very valuable. Every time interest rates changed, a trader's portfolio would turn red. And it was really bad. So every time interest rates changed, portfolios would turn red. Why? I don't get that they didn't prepare ahead of time. But anyway, now, whereas hedge fund managers are more equipped with managing their risk. The first part of the year is over, and hedge funds really did bad. Not all of them did worse, but some did really bad. The investment banking traders probably did much worse. So the next round of what are you going to hear in the media is the investment banks are having trouble. And what they do is, before they actually mention that, they cut back costs. And so you're going to see a lot of layoffs, etc. That's going to further going to affect the housing markets because people are not going to have money for their mortgages. Other companies are going to have to restructure themselves based on a different type of market. So if I could help you how to position your portfolio, is focus on stocks that do really well in a slow economy. So do not focus on stocks that contain anything that have to do with building, anything that have to do with like household decorations, because people now have to come up with more of a down payment for the same house. Yes, the house price will come down in the future, the next 3 years, but they're not going to be able to put everything on a loan to buy their furniture, to redecorate, to do new kitchen, etc. Because money is going to cost more. So they're going to be less likely to borrow more than what they need for their mortgage. Secondly, they're going to have to put more of a down payment on to buy the house. So that's going to affect them. And that's going to affect a lot of companies out there that were producing products for that sector. So you have to think about the supply chain in that sector. This is why I say focus on products that people actually need. Companies that make socks here in America, companies that make just whatever it is that people actually need it, whether or not they buy a house or not or whatever. And so those are the products that you should be focusing on, including any products that are kind of, I would say in about a year or so, you could probably enter the stock market and buy up a lot of different companies for, a lot cheaper. So it will be at its lowest in about a year. Of course, it will always go down and go up, but it'll be at its lowest. So you could literally focus on products that people really need. So again, that baby food is a really good company to purchase. Of course, they're having trouble now with the supply chain, but it should be here. It should be made in America. So once they transition to have it made here in America, because of other things that are going to happen in August, it's going to affect that market even worse. The supply chain is going to be heavily affected by this August. And we will see this to be the typical, I would say, typical reasoning behind the markets is the supply chain. Because it's one thing for big companies to borrow money. Okay, now they have to pay more for that loan, but they can't keep borrowing money. So even though they have a company and they're selling products, well, their shelves are empty. It's not that people aren't buying the product or can't buy it. It's not available. And so there's going to be a transition to making that happen so that doesn't happen again. Of course, we need the government's help. That's happening now. And so you're going to see a transition that we didn't see in about 30 years. And you're going to see this transitioning happening now. So focus on companies that supply those sectors. So not so much on the building sector to build residential, it's more of companies that build commercial, meaning warehouses, companies that supply the raw materials to build those warehouses, companies that focus on the prefabricated buildings. A lot of companies need machinery, so metals are going to be doing a lot better. Of course, gold prices will go up continually for about another year or so, year and a half, and then you kind of want to get out of your commodities portfolio. And you want to invest back in the stock market because it will be at its lowest. Makes sense? So right now we're going through a transition in the stock market. This has to happen because, it's gone up for so long, it can't continue to go up. So, and when this happens, the market gets very choppy. So that's why the first 4 months of the year were really choppy. traders were not really able to enter with a direction because there was no direction. Yes, there's traders that don't need a direction, but for the majority, is a long or short strategy, and that does really well, but you need a direction. And so hedge funds out there that are focusing on the equities markets, long or short, they will do well this coming summer till the end of the year. But this first season was terrible. The first quarter was really bad, and unfortunately they're going to have to make the money back for the second quarter, but the second quarter is still bad. But now we see a direction in the markets, and we pretty much know what's going to happen. So I want to thank you so much for watching. Please remember, if you like my videos, to do thumbs up so I can make future videos, and that will let me know that you like those videos. Please remember to subscribe to my channel so that you get my future videos and my market predictions. And please remember to share my videos with at least 5 people, so that other people get to see these videos and they also get the benefit for what I offer. And then finally, send me messages to a live chat so that I could discuss this in detail with you directly, so that other people could also discuss the questions and answers and stuff like that. Thank you so much.